We're getting it up right now, so give it about 2 minutes and we'll be up and running.
All right, I think it's up here.
Okay. All right, John.
So what do I
think. John, you there?
Yeah, I'm here.
All right, so what's he got to do? He's just
open it? Well, I don't have Office.
Oh, no, we don't have Office.
You're going to have to load them into a Google Slides doc.
Oh, so open with Google Slides.
We never had this problem before.
All right, I think I have it here.
All right, so can people see? We got to put it.
You have to go back to the. Yeah, turn your microphone off and on for a minute.
All right, you guys, sorry about the delay. Raj is going to take over. I know you wanted to ask me the VIX question, but you can ask.
Okay, I'll
ask the forum too. Okay, he's going to have some questions for you guys, and we'd like it that you participate. Okay, thank you very much, and thanks for your patience.
Hello, everyone. Can you hear me? Okay. Welcome to my presentation. Okay. So yes, echo. All right. Anyway, so I think that's an example why it was much easier to trade before computers. all you guys that trade now, if you use all this complicated software, that's why it's easier to trade back when I used to trade off sheets. Anyway, so this is my background. You can Google it if you want. It's not that exciting. Yeah, I think Danny's giving me a much. I had my agent Danny give me a much better present intro, and he's going to get 10% of all the money I make today, which is hopefully going to be $1 billion. Anyway, so let's get to it. So I want to talk about one of the most talked about financial instruments or terms that you hear about on TV or in the media, but also probably the most misunderstood, which is volatility and the VIX. Most people that talk about the VIX talk about it, but they really have no understanding of what it actually is, other than a term that they just love to throw around like they're geniuses. So let's begin here, and let's talk about the VIX and what, and more importantly, not only about the VIX, what's important about the VIX and what you should care about and how to use it in your trade. So let's talk about simply what is the VIX. By definition, the VIX is the ticker symbol for the CBOE's volatility index, which is essentially the expectation of future 30-day volatility calculated by S&P option prices in the market. And the VXX, I'm using that as an example because a lot of retail investors don't have futures accounts and want to be able to have exposure to the VIX or to volatility, and they use the VXX as a proxy for that. Cool. All right. So let's look at a VIX chart here. So this I pulled up this morning. The VIX as of this morning was around 16, which, as you can see, is slightly. Well, that's one day, but I should have had a longer term chart here. But it's basically near it's near the lower end of its trading range for the last year. So, but more importantly, when they talk about that actual level, what does that price mean? A lot of people don't understand what the actual level of the VIX is or what that means. So basically the VIX formulates a theoretical expectation of stock market volatility in the future. And what's most important about this, and this is very important to remember. So 16.25. If you see a VIX of that means that the market expects the S&P to move an average of 1% a day in the next 30 days, up or down. Oh, are these things disappeared, guys?
So, hey, Raj.
Yep.
Your charts are down.
Okay.
Can you go into the chart computer and fix this so that?
Yeah, can you give me team viewers?
Hold on. We'll go back.
Yeah,
No problem.
He put me into the other computer, the chart computer.
All right, we'll take a pause here while we lose my charts because they're pretty important.
I don't know why I don't know why he separated it. You mean in the screen shares?
Yeah. Does it come up?
I don't even know where these fucking. John did two things. I don't know what he did. He moved me off the one computer that I usually chat on onto the chart computer, and he set up the screen share through Raj's Google email. I'm horrible at this. I mean, hold on. Here, can I get in here real quick?
Hold on, guys. Well, we're gonna fix this. Don't worry. The VIX isn't going anywhere.
Do I click one's going forward?
Turn the mic off.
Your mic is live.
All right, your mic's on.
All right, I'm live. We're back live. Okay, so who knew that the most volatility today was going to be trying to put up my presentation? Anyway, so I guess we're going to go through this, and I will answer questions all at the end. So, like I was talking about, the VIX is the market's expectation of future 30-day vol, and let's look at a VIX chart. So, it's supposed to have a 1-year chart up, but this is the 1-day chart. But anyway, the long-term VIX right now with a level around 16. That's basically at the lower end of its 1-year range. And but the question is one of the most misunderstood things about the VIX is no one, while it's quoted often and it's thrown around as a buzzword, many people, in fact, I feel most market participants don't actually know what the price of the actual VIX actually means. And it's very important to understand this. So if you have a VIX, and I'm not going to go through all the math because it's not that important, to be honest. But a VIX price of 16.25 means that the market expects the S&P to move an average of 1% per day for the next 30 days, as calculated by S&P is a strip of S&P option prices. Now, the VIX itself has no predictive power, but it can be used to gauge of what the market expects volatility to be in the coming month. But remember that number; it's pretty linear too. If you get to 32.5%, that means the market expects the S&P to move 2% for the next 30 days. So the question is it actually a buy or a sell at this level? So let's look at some historical data here on the VIX. So look at this slide right here. So currently, if you look at the bottom part of the slide, the 10-day realized vol, the previous 10 days has been about 10.5%. The previous 20 days has been about 12.5%, and the previous 30 days was a little over 14%. If you look at it 1 week ago, it was all 10 days was a little bit higher, 20 days about the same, 30 days realized was a little bit higher as well. If you look at a month ago, you guys all remember the turmoil in December. If you go back 1 month, the 10-day realized was 23%. The 20-day was about 30%, and the 30-day was all in 27, almost 28%. So as you can see, and then if you actually go further along to the right, you can see that the highest 10-day realized period basically approached 40%, which is essentially 2.5%. Excuse me. Yeah, about 2.5% a day. And the lowest 10-day realized vol is about 4%, which is basically moving 25 basis points a day. So you can see there's been a big range of historical realized volatility in the last year, and probably about as big of a range as you'll see over a year because you typically won't see very high levels of volatility and very low levels of volatility all in 1 year. They tend to trend much more than that. So that was actually in a lot of ways the 2018 was a big outlier. So what does that mean now? Does that mean that the VIX is a buy or a sell here? Well, let's put it like this. So with the a VIX right now of around 16, if I had to make a bet of whether the next 30 days would be higher or lower than 16%, well, one thing I would do is I look at the previous 10 to 20 days, and if you look at it, it's between 10.5% and 12.5%. So if someone asked me, Rod, you want to bet $1,000 on under or over 16? More often than not, statistically, you would probably bet under because of recent volatility. I can assure you that more often than not on that basis, you probably would be under. Now, the VIX is priced that way for this very reason. It's very important to understand this concept because of the likelihood that there's probably the greatest likelihood that the VIX will realize some 12 and 16 in the next 30 days. But the reason it's priced at that level is at a higher level is because it's bound on the downside at essentially zero, but realistically it's probably not going to realize much lower than 10, but it could go to 40. So in the 5 or 10% likelihood that it realizes very high, that's why the VIX is priced higher. So in reality, the median of where the VIX is probably going to realize in the next 30 days is probably around 13 or 14, but it's higher because because of the tail risk on the upside of higher volatility, and that's why there's always a risk premium to the VIX relative to what it should be. Right. Yeah. So the question is the VIX actually a good hedge or a good bet to bet against the S&P? Because historically, there was almost always an inverse correlation between the VIX and the S&P, meaning as stocks go down, implied volatility goes up. So a pullback in the S&P should mean a spike in volatility. So let's say this. So say you have two choices here. Say you're currently bullish, but you're expecting a temporary pullback. Should you buy the VIX or Volley or the VXX just as a hedge? So let's look at some chart to see if this is a good hedge. So here's a chart from basically 1996 to 2016. This is a 20-year chart, and the top line is the S&P 500. The bottom line is the VIX. And as if you see all these green circles, those green circles were near-term bottoms. And if you could see on the red chart, almost always there was a spike in the VIX. Most severely, if you can see over here in 2008, the VIX got up to 80, and that was basically the bottom of the stock market up until recent. That if you bought there and held, you pretty much caught the bottom. Now I'm not going to. It's very naive to say, oh, well, if the VIX spikes, you should buy the S&P. It's a buying the market. Well, you know what? It was here. If you look at 08 here, it's hard to predict. And I'll say it's almost impossible to say when the markets are essentially going crazy. It's by no means easy. Let's look at another chart here. This is the S&P. This is based on the S&P returns of 2009 to 2015. As you can see, pretty much, it's the S&P went straight up for the most part. The VIX, minus a few spikes, pretty much went straight down. The return from 09 to 15 was a little over 100% in the S&P, and the VIX return was about minus 70%. So a pretty clear negative correlation. So as you can see, the VIX and the bottom on a VIX means general amount of spike in the S&P. These have trended in opposite directions. So is the VIX a great hedge to the stock portfolio? Well, the answer is not true. And the reason is it takes a much more in-depth understanding of how they work. Because in fact, and I'll tell you a story, and I remember sitting through these presentations right after 2009. These ETF providers were pitching individual investors how great the VIX or the VIX ETF, which was created, was a great hedge to the portfolio. And back testing it up until, and using 2009 as an example, it was an easy sell. Many retail investors fell for this, and they got absolutely creamed. But looking at 2008, it seemed to make sense. If you look at the volatility of 2008 and the market returns, convincing investors to put 20-25% of their portfolio into the VIX as a hedge to their long-only portfolio seemed like a home run trade and seemed like a trade that was easy to get investors into this trade. But let's see how that actually performed. So if you look at when the VXX was created, it's not a surprise actually that it was created to the as a result of the greatest volatility event of all time in stock market history. So if you put 25 grand in 2009, by 2017 you had zero. Well done. I guess they say hedgers are supposed to lose money, and they certainly did. But let's look at some of the returns. So this is I actually first did this presentation last year. It's ironic that and I'll explain why it's ironic, but we'll go through that right here. So looking at basically until the end of 2017. I think the date on this is it's sometime in January of last year. But anyway, if you look at the key numbers here, if you look at the most important numbers are look at the bottom of the screen. Look at the 1 year, the 3 year, and the 5 year return, all massively negative. This next slide is going to be even better on this one. So you can see here, these are the yearly returns of the VXX, which was created in 2009. As you can see, your best year was 2011. We lost 4%. Every other year was high double-digit negatives. In fact, some of them in the 70% range. And I remember sitting here when sitting through these presentations. A lot of these ETF providers were telling investors that putting 25 to 50% of your exposure into the VXX and hedge was a way to really protect your portfolio, even if you were bullish on the market going forward. And while that seemed to make sense, let's see how that actually worked out. So here are the returns of the VXX. Here are the returns of the S&P. As you can see, every year they're positive, except for 2008. So let's say that you put in 25% of your, let's say you put 25% of your portfolio into the VXX as a hedge versus the S&P. You would think that that would give you some protection and probably still have positive returns. Seems to make sense. So let's look at the returns going forward. So if you did that in 2010, if you put 25% of your portfolio into the VXX and the rest of it in the S&P, so you lost 25% of 72%. So that's 18%. So you lost 18% on your hedge, and you made 15% on your portfolio. So you lost 3%. In 2011, you put 25%, you lost 1%, you made 1%. You guys got the drill. I'll do the math. In 2012, the same way, You put in, you lost 19% on your hedge. You made 16% on your stock portfolio, so you lost 3%. 2013, you actually made about 15 or 16%, including your hedge, which is the first only year you really made money so far. 2014, you made about 7% net. 2015, you lost 8% with your hedge because the market didn't really do anything, but the VIX still lost 36%. 2016, you lost about net 5% because your hedge lost much more than your portfolio. And in 2017, you made about 3%. So as you can see, if you back test all that, if you add that up, I think it's somewhere around zero. Your hedge basically wiped out all your gains. So talk about a hedge, not really a hedge. Not really a hedge at all. So, and again, it looked great until back testing before 2009. It looked like a great trade, but as you see, it certainly was not a good hedge. So, a bit of a summary on the using this as a hedge. These things did not exist until the greatest until the financial crisis in 2008, and then investors got absolutely creamed. But they pushed this ETF as been taking advantage of retailers by pushing this as a perfect hedge to your portfolio. As you know, there is no perfect hedge. In fact, this was a much worse than a perfect hedge. This cost you money. So, and the thing that you can see is two important points from that. You can see, even though there's clearly a negative correlation between the S&P and the VIX, it's difficult to know what's the right notional amount to use as a hedge because the returns of the VIX are so inconsistent. If you said you want to buy S&P puts every year to protect your hedge, to protect your portfolio, that one at least you know how much you're going to lose. You know your downside, and that actually would make sense. But using this as a hedge is just not it's not a good strategy because you just don't know how much to hold. And now I'm going to go even further to show you another example of how bad of the dangers of trading this. So that all that data we showed was up until the end of 2017. So let's see how it did in 2018. And I'm sure a lot of you guys remember 2018, or have you haven't paid attention to the volatility in 2018? But I'm going to show you basically what happened. I'm going to actually share a personal story before this happened. So what happened after all these years of people losing money on being long VIX, so a lot of retail investors and professional traders, and I know, they decided, they realized, they just thought, you know what, short volatility is a trade that's always works. It's if you back tested those 7 years, which I kind of just showed you, it's always good to be short vol. And a lot of them, every time the market would have a mini sell off, they would get short the VIX and thinking that's an easy trade and just collect money. I remember I was playing golf with a guy in about this time last year, right before the great volatility event of February 2018. He was telling me how this is the easiest trade in the world. And then there was a bit of a vol spike. And he called me. He's like, "What do you think about this?" I'm like, "Well, I actually know this is about to be broken. This trade is actually now broken." He's like, "No, Raj, you're a fucking idiot. You don't know what the fuck you're talking about." I'm like, "All right." The guy lost $4 million as his PA. The only good news was he had disinvited me from his daughter's bar mitzvah, so therefore I'd have to go to that stupid thing, and I'd have to give her a gift. But basically what happened was, after years of retail and even other trade, even more air quotes professional traders, they thought just shorting the VIX always was a easy trade, and they got absolutely creamed in 2018. There was a product called the XIV, which was the reverse VIX. That one eventually had a ball shock, and they were tied into these ETNs and some other products, and they were just broken by market makers and professional vol traders, because we all knew what was in these. It was all basically, I don't want to bore you with the minutia of the trade or the trade structure, but basically these retail portfolios were wiped out. Some of these vol ETFs went up by as much as 300% in a day, and the S&P itself, I think, from peak to trough, only went down 10%. So that was clearly not in their models. I know a couple Wall Street firms that lost close to $500-600 million. There was actually one firm that I know was although on the other hand, I do know one firm that I think they actually made $600-700 million on this trade, but that was to their investors. They were on the other side of their customers' trade, so therefore that's really not talked about and not disclosed because it was tied to a exchange traded note. So talk about them not looking out for the investors. So therefore that hasn't been disclosed anywhere because of how bad the optics are of that. So I guess the thesis of this is when these financial products are on weak hands and they're owned by people that don't fully understand them, you can dislocate this market. And people like me, a lot of the VIX traders on the floor in Chicago, that we all knew this could happen, and there was a way for it to happen. And this is exactly what happened in February 2018. And really a market that really wasn't that volatile. And honestly, it's not that dissimilar to what happened in 2008 when people were trading credit products and CDOs and other products where a lot of people just bought them without even understanding what they were actually buying. So have that a lesson to make sure if you're trading stuff, stick to stuff that you understand. Not if you start trading products you don't understand or have an idea of what can happen when things get bad, things can get bad. So you guys remember this chart here. So let's look at remember we just did this. So now let's look at I did this. So let's look 2 months after. This is essentially 3 months after the beginning of 2018. March 26th, that's my birthday, by the way. So that was my birthday present to you. Guys, if you want, send. It's about a month from now. Send cash or gold or whatever you want. But as you can see here, you remember this chart here of like the inverse returns of the market in the S&P. If you look at the first 3 months of 2018, the VIX on the left returned 59%. So if the VIX was up 59%, you would think that the market would be down, right? No, in fact, the market was up 2%. So the retail investors that just thought, okay, well, I want to get short. I want to get long the market. I'm going to get short the VIX here. Well, they lost 59%. And the market was higher. So now they're like thinking, what the fuck just happened? Wait, this wasn't supposed to happen. What happened to that inverse correlation that is supposed to happen every time the market goes up? Well, it clearly didn't happen, and it didn't happen in a big way. So let's actually look at it from one. Now let's look at, and I actually I did this chart yesterday. So, or this, I pulled this up yesterday. So this is actually the 1 year return. Let's look at how it's done the last year. So in a 1 year return, as you can see, the S&P is down 2.5% 1 year from today. So what would you guys expect here? You would expect the VIX to be up. All right, so let's see what the VIX has actually done. Actually, let's look at two. Let's look at the year. Let's do two things here. Actually, let's look at the year to date and let's look at the 1 year return. So year to date, the S&P is up 8%, and the 1 year return of the S&P is down 2.5%. Okay, so you would expect the year to date for the VIX to be down probably a pretty good amount, and the 1 year return to be slightly higher, I would say. The year to date return of the VIX is actually almost 37%, which is actually kind of what you predict. That's almost that's more of like the long-term average, more like the long-term. You remember this chart? That's probably more in line with what you'd have expected. But what about the 1 year return? Well, the 1 year return is the S&P is down 2.5%. So if you bought your VIX as your hedge, you would expect to make money on that. Except the VIX is down 17.5% in 1 year. So again, the correlation broke down. So what is the thesis on this? What should you take away from all this data I'm telling you? Well, I think the main thing you take away is that while that inverse relationship usually happens, it usually only happens for it happens for a short period of time. It's a pretty good way to play a short-term trade, but over the long term, this trade breaks down tremendously. If you told me within a week you expect the market to be down 5% from here, and you said will the VIX be higher, I'd say with almost certainty yes. But if you said to me, Raj, the market's gonna be down 10% by the end of the year, what's the VIX gonna do? The answer is I have no fucking idea, because you really don't. It's so path dependent. There's so many things that can happen and change it where it's not. The point is it's not a good buy and hold strategy to play a reversal of the market by trading in VIX products. But in a short term, as a trading tool, it can be effective. So remember, like there was a clear negative correlation for 7 years, and in 2018, the trade completely flipped. And like I said, there is a negative correlation, but the returns are inconsistent. There's path dependency, and like I said, if you don't know how to trade these products, you're simply writing checks to the market. The good thing is it can be taught. Like someone like me, we can do this much more in depth, but this is a pretty broad background of what to look for in the VIX and the VXX, and how they can be used as effective trading tools, and they can be money makers for you. So, guys, I hope you enjoyed what you have. This is some of my contact information. If you want to get in touch with me, it's my Twitter handle, Raj Mahal Tweets. You can always contact me by LinkedIn if you want to talk about, do something private, or we talk about. I mean, I do seminars and classes on fundamental analysis, volatility, trading, everything. We do this, and I do these mentoring programs. I work with my business partner in Singapore, where we do a vacation program to Thailand. You get to spend 10 days with me, and me and my partner and one of my other colleagues from London, and we spend 10 days in Thailand working together, teaching you and having fun. So if you want any information on that, you go to the website www.itpm.com. Right there is the trading mentoring, and then we have one coming out in October. Usually it's October and April. I'm sorry, April and October we have one. And if you're interested in that, or you want any more information, you can reach out to me, and we can go with that. And with that, you have any questions?
Hey, Raj, hold on just a minute. I just want to talk a little bit.
Yeah, let's have some questions. Yeah.
Before Raj takes any questions, you guys, I want to hold on.